Hey everyone, my name is Jack. Welcome to the channel. I cover a variety of topics as they relate to investing, personal finance, real estate, and all that sort of stuff. If you like that sort of content, be sure to take a look around the channel, and if you like what you see, definitely subscribe. And if you don't like what you see, still subscribe, since it helps me either way. Now lately, a lot of my content has revolved around the Federal Reserve, our good friend, and Jerome Powell, the chairman of the Fed, who have been printing all sorts of money to increase liquidity in the markets by just creating money out of thin air, basically, and have been buying things like ETFs, specifically corporate bond ETFs. Now, even though the Federal Reserve is not supposed to legally be buying ETFs of any sort, it's only supposed to be buying things rooted in treasury bonds, the Fed has been working around that through some legal technicalities, and the government is letting them do that, but that's beside the point. This is just a good excuse to talk about what ETFs actually are, how they're made, and what you can do with this knowledge and how you can actually start investing in ETFs if you so desire. But just a reminder, I'm not a financial advisor and I'm just a guy on YouTube trying to give my perspective on things. You should come to your own conclusion whenever you're investing in anything, taking out debt, all that sort of stuff. That is all up to you to do your own research. So don't come suing me if you end up losing money, because you never know what's going to happen in the future. Now, ETF has a very sort of mysterious sound to it. Who knows what on earth an ETF is? I'll go ahead and throw my money on it, but what is an ETF? Besides being an acronym, which the financial world has plenty of and seems to always want to have more, ETF stands for Exchange Traded Fund. The exchange here being a stock exchange, like the New York Stock Exchange, where buyers and sellers can freely exchange a share of this fund, unlike some other closed funds. Closed funds being those that have a lot more restrictions from the fund itself that prevent you from buying and selling it so freely. Maybe it'll have certain minimums that you need to meet, or there will be some deadline that forces you to keep your money in there. You can't pull it out freely, that sort of thing. But with an exchange-traded fund or an ETF, you can actually buy and sell shares of that fund freely on the open market. But what exactly are you exchanging? Well, it could be a variety of things, but ETFs are basically shares of a fund, and a fund can own all sorts of things. Oftentimes, ETFs are used to mimic the performance of certain indices, like the S&P 500, for example, the 500 biggest firms in the US stock market. So a fund will go and buy the proportional amount of the S&P 500 firms, put them into one package, and then divide that package up into a ton of shares and sell each one of those shares as an ETF. So really all you're getting with an ETF is a small portion of a much larger fund. It's a lot like a mutual fund, only mutual funds tend to be more exclusive and maybe have big account minimums and, again, restrictions, like I mentioned before, since they can't necessarily be exchanged freely on the open market like an ETF can. It's in the name. One of the most popular ETFs is SPY, which is the S&P 500 ETF. This allows you to buy a share of the S&P 500, essentially. You buy a share of this fund that owns a bunch of shares throughout the S&P 500 in proportion to the market cap or the value of each of those companies within the S&P 500. So buying one share of SPY basically gives you the value of all 500 firms in one tight little package. Obviously, it's a very tiny portion of each of those firms, but that's the general premise. For example, there's ETFs based on commodities like gold and oil and that sort of thing. And there are also ETFs that are focused on sectors like industrials or technology. So you have a lot of flexibility to buy ETFs to then give you instant diversification within whatever sector, whatever goal that fund has in building your portfolio. The whole point of ETFs really is convenience. You can get instant diversification among a whole sector, even a whole market, just by buying one share of an index, rather than having to buy a fractional share of every single company on the stock market or whatever that index is trying to track or whatever that ETF is trying to track. You just buy one share of the ETF and you're all done. You have the diversification built into that share of the ETF. It's very easy that way. There is a price that comes with this convenience. One is that you just don't have control in actually how that ETF balances itself, since it's following whatever index. You can't fine-tune it yourself in that way. But more importantly, a lot of ETFs have fees attached to them. Some of them can get pretty hefty, so you have to keep an eye out for the expense ratio on whatever ETF you happen to want to buy. Because even if an ETF is returning you 7% per year, if it has a 1% expense ratio, it's really more like it's returning 6%. So now that 6.5% return ETF that has a 0.01% expense ratio looks much better. And that goes for any fund really, not just ETFs. Always want to look at your expense ratio whenever you're investing in stocks and funds, because an expense ratio compounds with all of your returns. So your 1% expense ratio compounds over the 30 years that you're invested, just like your stock returns. So the expenses can really add up too. So the lower you can get those expenses, typically the better. Thankfully, modern technology and market competition has brought down expense ratios quite a bit, and you can typically invest in broad index funds with very low fees through services like Vanguard, Fidelity, Charles Schwab, lots of different options out there for very cheap index funds. And you don't actually need to use those brokerages to get into these ETFs. You can use any brokerage really, because these exchange traded funds are exchange traded, they're publicly traded. So any brokerage that has access to the public markets can get access to these ETFs as well. Even in my own portfolio on M1 Finance, I own a couple Vanguard ETF funds and a bunch of other ETFs as well, not through Vanguard, but through M1 Finance. So you can get access to a particular brokerage's products through an exchange on a different brokerage if you so desire. Speaking of M1 Finance, I highly recommend you check out my M1 Finance portfolio series that I update every 15th of the month. I'll go ahead and include a link up above. Definitely take a look at that series if you're interested, not only in M1 Finance as a platform, but also just in certain strategies that you can take while investing and different perspectives on the stock market, and seeing how you can actually build a portfolio for yourself. If you actually want to copy the portfolio that I use in that video series, you can easily copy the link down in the description of each of those videos that shows you the holdings that I had at that particular time when I filmed the video. I updated every single video. So you can quickly copy paste that portfolio into your own M1 Finance portfolio and use that as a base for starting your own if you want. Again, not a financial advisor, it's all up to you. But it's a good start and could maybe get you going towards your investment goals if you're not familiar with stocks or if you're not familiar with M1 Finance as a platform. I am affiliated with M1 Finance, so if you open an account and end up funding it, I might get a small commission. No guarantees, but I would appreciate it if you do sign up for M1 Finance. It's a really great brokerage either way. I would definitely check it out at the least. And I forgot to mention, it's actually a free brokerage, so there's really no risk to at least check it out and open an account. You don't have to fund it. Just take a look for me. So to recap, an ETF is an exchange-traded fund. It's just a slice of a much greater fund that a certain investment firm or brokerage has put together, and then you could quickly buy a share of that fund to get all of the underlying assets that that fund has purchased in a much smaller package. You can then sell those shares of the ETF if you don't want them anymore very easily because they're on an open exchange. It's in the name exchange traded fund. So you have a lot more flexibility with the diversification that you get with an ETF as opposed to more closed-ended funds or more expensive funds that don't have as many options for quickly getting in and out of them. And if you're looking for more brokerages where you can buy ETFs on them, you can take a look at my links down in the description for Robinhood and Webull. If you open up accounts with both of those, if you don't already have accounts, you actually can get some free stocks by doing that. So you might as well open the accounts and get those free stocks. And then if you really want to, you can just sell them and close the accounts, or you can use them to buy shares of ETFs. Whatever you want to do, but definitely take a look at down in the description for those links. But otherwise, that's all I've got for today. If you like this video, please like it since it helps the channel out a lot. And definitely subscribe so you don't miss any new updates about my stock portfolio, my real estate ventures that I'm trying to get into, and all sorts of other topics on personal finance and investing and the markets. We're definitely in a very interesting time in the financial world, and I definitely want to allow you to get some different perspectives and definitely keep you updated on the facts as they arise. But until next time, take care.